he'll be speaking about the very quantitative side, but really the real modeling on the VC side of things. And then we'll have Peter with his Peter has had a very early on background in investment banking with JP Morgan, both in London and Hong Kong, and then he did a lot of private placement deals, and now he is a principal at Merida Financial Group, and so he'll be talking about the qualitative aspects and sort of the simple valuation metrics of the venture capitalists use. And then finally, we'll have Euwyn, who is graduated from law school from Cornell and worked in a law firm in New York. And afterwards, he founded Opsy in the Silicon Valley. And then he got funding from Y Combinator, so a very prominent fund over there to see what business is from an entrepreneurship perspective. So let's welcome Professor Thomas Hellman.
Thanks very much. I don't mind going first. I'm going to work you hard. And what the organizers asked me to do is show you a little bit of the number crunching. So this material that I'm going to present is in principle worth about 3 hours of lecture. And I'm going to not do that today. I am going to make sure that we're done by 5 o'clock. And so the objective is that I'm just going to give you an idea, a sort of an overview of the key technical concepts that you should be familiar with when you're thinking about venture capital and startup businesses. So you guys probably end up using a bunch of these tools, not all. And I'm going to make those slides, or the organizers are going to make the slides available, and there's a bunch of other stuff on my website if you're interested. So feel free to use those additional materials. It's not a bad idea if you interrupt me. I don't particularly find the sound of my voice terribly interesting, so I do not mind the interruptions, questions, clarifications, and everything. It'll make it more fun and give me a better sense of where you guys are at. How many of you are taking entrepreneurial finance? 1. Okay. Objective, we understand some basic terminology of what I'm going to call private equity deals, understand some basic math, and then understand how at the same deal entrepreneurs and investors have a different way of looking at that. This is the first set of slides. I hope to go through 2 sets of slides, but I'm not going to cover half each of the sets. Done. Here is a basic fundamental equation that you need to understand. It's an accounting equation, and it says investment is going to be equal to an ownership times a valuation. What does that mean? Ownership, sorry, my voice is terrible today. Ownership is the percentage of shares owned by the investor, and the valuation is going to be what we're going to call a post-money valuation. So here's the first concept that you should get familiar with. There's a difference between a pre and a post-money valuation. A simple way of thinking about it is post-money is the second after the money arrived. Pre is the second before the money arrived. This equation tells you basically that what the investor gives in terms of investment is going to be made equal to what the investor receives. So if the investor gives an investment and receives an ownership fraction and a valuation. This valuation is not real value. It is really an accounting number that makes those two things equal. You might think that you have you're paying $1 million and you're getting 20% of a company. That's going to imply that this company is worth $5 million, 20%. $1 million divided by 20% is going to give you $5 million. It doesn't mean that your company is really worth $5 million. It just means that you've agreed to a deal that was equivalent of $5 million. So here's a bunch of terminology that I used in these slides. I'm going to skip that and just give you the basic formulas. Investment is going to be price per share times number of shares. Pre-money valuation is price per shares times the number of existing shares. Post-money valuation is price per share times the number of existing plus new shares. All of this is explained on the slide, but this is total number of shares. Later on, we can add options, but that makes things more complicated, so we don't want to complicate things. Here's what should give you the key intuition. Take a particular deal. Suppose the founder wants to have 3 million shares, because 3 million is a cool number, it makes you feel important. That number has no significance whatsoever, it turns out. But the real significance, the nominal significance. Suppose there's an investor who wants to put in $1 million shares, the investor is willing to pay $2 per share. We can express this deal. It's an investment of $2 million. Why? The investor is paying $2 per share and getting 1 million shares. It's a pre-money valuation of $6 million. We've got 3 million outstanding shares before the transaction. Those are the founder shares. And the investor was willing to pay $2 for them, so we're going to value them at $2. That makes it a $6 million pre. It's going to become an $8 million post. Why? Because we're getting the pre of 6 plus the $2 million of investment. That's 8. Or another way of looking at that is the total number of shares is 3 million existing shares, 1 million new shares. That's 4 million shares at $2. $8 million. Now, I'm going to tell you exactly the same story a second time around, but I'm going to use slightly different language. I'm going to use the language of ownership fractions. It turns out that you can use 2 languages to describe the same thing. The language I just used was price per share, number of shares. I'm now going to express the identically same idea with ownership fractions. Here are a bunch of formulas that you can figure out. They're extremely useful for calculating these things, and I'm going to go straight to the example. Suppose we have a founder who has 3 million shares, and suppose the information that you're given is that there's a new investor that's investing 2 million shares and taking 25%. By the way, this is the way that the information is always presented in the Dragon's Den. I'm investing X million dollars for Y% of the company, right? Well, what do you do with this information? Well, post-money valuation, you figure out that it's the investment divided by the fraction that the investor is taking. So this is the calculation you have to watch every time you're watching Dragon's Den. You take $2 million, you say they're taking divided by 0.25. That's always, you may calculate it normally to do this, but this is in this case, it's easy. Divided by 1/4 is the same as multiplying by 4, and that gets you to $8 million. Pre-money valuation is going to be post minus the investment. So that goes back to 6 million. It's the same deal. The price per share, the way we're going to calculate the price per share is typically we take the pre-money valuation and we divide it by the number of existing shares. 6 million is the pre. We know that the founder had 3 million. Therefore, the price per share must be. Same deal, but instead of starting with number and prices per share, we're starting with investment amount and ownership fraction. And there are 2 equivalent ways of describing a deal. Yeah?
So this is considering issuance of new shares as a method of purchase, right? Is there any cases in which there's a transfer from ownership of shares?
It doesn't really matter. So again, the standard situation, for a startup with companies issuing new shares, you could have a founder who says at the beginning, I own 4 million shares, and now I'm transferring 1 million of my shares to the new shareholders. That does make a difference. This stuff matters more when we're going to an IPO and we're issuing shares, and some of these are founder shares and some of these are new shares. And we have to get into those complications. In these early stages, that distinction isn't terribly important. Good question. Anything else? Good. I'm going very fast, as you can see. That's good, maybe. Number of new shares. Well, we now figured out that it was $2. We invested $2 million, so it must be that we're getting 1 million shares. These formulas will become second nature to you, but it's nice to have them written down once so you can sort of figure out. This is basically, it does focus on us on a traditional negotiation. The easiest way to think about a negotiation is that the investor and entrepreneur agree on an investment amount. In that case, the entrepreneur wants a lower valuation or a lower price per share, and the entrepreneur wants a higher valuation or a higher price per share. And that's the basic economic conflict for which we're not really gonna, get away. A couple of caveats. One is sometimes the negotiation is a little bit different. Some investors, and this is, as you get to know the investor world, there are different ways of thinking about this. Some entrepreneurs really have target ownership. They say, if I invest in a company, I need to have 30%. Otherwise, it's not worth my time. I don't ever invest in a company unless I got 30%. Well, what do you do if an investor tells you that and you don't want to give up 30% of your money? Well, if that's not negotiable, the ownership percentage, what you ought to do as an entrepreneur is say, well, if you want 30% of my company, you need to invest a larger amount. And so, basically in the previous logic, we held the amount of investment constant. The moment you put in investment as another variable, you can maybe satisfy both of these requirements. You're taking on more money. That may or may not be a good idea for the company. Too much funding can be a bad thing in the early stages, but it gives you at least one more room for negotiation. And here's a big caveat. When you're looking at this, you might think, well, basically as an entrepreneur, I should always go for the highest price per share, or I should always go for the highest valuation. That turns out to be a dangerous way of thinking about financing startups. Sometimes the better quality investors offer the lower valuations. And the lower valuation from a better investor may actually be a good deal. It may be much better for your company. So the basic logic is sometimes you want a smaller slice of a larger pie. Just let me go all the pictures. Let me give you an example. Suppose we're going to take the deal that we looked at before, and that was the deal offered by Clueless Capital. They're clueless, but they're offering you $2 million at a post of 8. So as a founder, I'm saying I'm only giving up 25%, I'm giving 75%. Suppose there's Whiskey Ventures, the smarter venture capital fund, or angel investor, who's putting in $2 million at a post of 4. That sounds like an awful deal. Founder only retains 50 as opposed to 75%. How on earth would you ever take that? Well, suppose that Clueless actually means that you think you're going to be able to do 10 million exit, and you're going to own 75% of that, so you're making 7.5 million. Sounds great, but WizKids, these guys can actually double your returns because they're smart and they're going to find you the right buyer, or they're going to help you build the right product, or whatever it is, and you think you've got an exit value of 20 million. Now you've got 50% of 20 million, and that's better than 75% of 10 million. So even though they're twice as expensive, if they generate twice the results, that's worth it. So this is just putting some numbers to a simple concept. Don't judge different investors just on the basis of price per share, because you care about the quality of the investment. And that turns out to be very important. So how much here the work gets a bit more complicated. In the classroom environment, I make people go through this exercise. In the interest of time, I'm just going to walk you through it very quickly here, because it's just an overview. But again, we'll have the deal that we looked at before. And suppose there's a different venture capitalist that comes along, and that it's the same quality. So I'm not going to worry about good versus bad venture capitalists. But they're willing to put in more money. And as an entrepreneur, you now have a more complex choice where you have to say, well, the most important thing I want to say in this slide is not a single metric is going to give you the right answer. So in this particular guide, example, I put in 4 incarnations of what this B investor might look like. And we're going to compare the offer from A that we have against some offer by B, and we're going to ask the question, at what point am I willing to switch from A to B? Am I willing to switch at an offer where they're investing $3 million and I'm getting it at $1.50? I 2, a 2, 50, or 3. We could have a long exercise about it. In the interest of time, I'm just sort of cut through the chase here and tell you what's going on. The answer is, you would have to be absolutely foolish to refuse the offer B if they're giving you this deal here. Why is that? On every criterion, this deal is better. They're giving you more money, you're getting a higher price per share, you're getting the same 25%, you're only giving up the same 25%, that's to say, you're retaining the same ownership. So in this case, you're getting more money, but you keep the same ownership. If they're of the same quality, there's basically no reason to reject them. So this is like definitely a better deal. The question is whether any of these are a better deal. So some people might say, this is a worse deal because I'm giving up more equity. I'm giving up 28% as opposed to 25%, and that's really important to me. Other people might say, no, hang on, this is giving me a pre-money valuation of 7.5 as opposed to 6 million. Some people might say, in fact, I'm just indifferent at a pre-money of 6, which is the same price. The point, though, is that there is no objective way of saying which of those is better. It depends on a bunch of other things. So, for example, suppose that you are a big optimist. You're a big optimist. You say, I know I'm only raising 2 million. I know I will need another million a year from now, say. And I think my company is going to look a lot stronger. In fact, I think I'll be able to get my next round of funding at $10 per share. In that case, you wouldn't take this. Because, you're sort of giving up a little bit more ownership, and you think in a year I will have to give almost up very little because I look so good. So an optimist may keep with offer A and refuse offer B, in all of these scenarios. A pessimist, on the other hand, may say, this guy's giving me more money. I'm going to take it, even if I get a lousy price. I'm giving up 40 instead of 25%. But you know what? I think this is the last chance I'm ever going to be able to raise the money. And if that's true, if I'm a pessimist, I might even take this offer even though and maybe having the additional money is just what I need in order to make this company. So the point is, in order to assess these alternative offers, you have to figure out something about the future of your own company and the likelihood of what the next round of funding is going to look like. It's going to get complicated. Most important lesson from here is you cannot judge a deal simply on something like the price per share, the amount of the percentage of ownership given up, or the pre and post money valuation. None of these are an objective criteria for choosing a deal. You have to go through a more complex analysis. So even though in a simple world where everything is the same and all you worry about is price, you can rank them. At the moment there are quality differences or there are investment amount differences, the simple ranking disappears. Okay, I think I've made the point. So here, if you look at the slides, I work through it, how different scenarios about your future make different deals more or less attractive. So this is a whole bunch of slides. Okay, one more thing from this slide, then I want to move on. This is an extremely simple spreadsheet. And this is the kind of spreadsheet that you will often find in a real startup. What it does is, there's no mathematics, there's nothing. It's all made up in this case. But it's useful to think about the evolution of ownership in a company over time, because the truth is most companies go through multiple rounds of funding. And so just what I show here is what can happen to ownership as the company grows. We don't need to go into the details here. I think that's not the focus here. And the rest of the slides talk about stock options. Employee stock options, it turns out, are somewhat important, and it messes up these calculations in a variety of ways that are too complicated for us to worry about now. Any questions? That was my 15-minute intro into the basics of pre and post money valuation. questions? Yeah?
Generally, through subsequent rounds of financing, you do get diluted a lot. What sort of a target that, as an investor, you want to avoid?
I don't think that you can say dilution per se is bad, because a successful company that proceeds well, it hits its milestones, it gets a big round of venture capital, may have a huge dilution, you may be giving up another 30–40%, but the value of the company is just skyrocketing. So the way that a venture capital firm thinks about this is slightly differently. They say, we know dilution is going to happen. How much money do we keep in our portfolio in order to continue to participate in the second, third, and fourth round? One of the big problems that angel investors have is that typically they don't have any dry powder. And so by the time they get to the second or third round, they're out of money and they have no negotiating. So the way to think about it is that the most important is to retain it, so that you can continue playing in the future rounds. Okay, good. Yes?
Quick question. What influences pre-money valuation? Because I saw that with the slide that we went over, different alternatives have a different pre-money valuation.
So this is the perfect question that I needed to transition to the set of slides. The second set of slides, which is what I've told you so far, is a purely mechanical description of the pre- and post-money valuation and the basic structure of an equity deal in a private company. That's all I've done. What's your name? Maria. Maria's question is a profound one. It says, where the heck do these numbers come from? Well, it's such a profound question that it's really hard to give you the correct answer. So what I will do is I will give you a flavor of where these numbers are coming from, and then I'm going to give you a couple of tools that pretend to give you solid answers in a world in which there are no solid answers. So why do we perform a evaluation? You might think something like objective value, and as much as accountants love that concept, in the world of startups, we are so far away from the objective value. We don't have current stock market data, we don't have transactions, we don't have reliable accounting data. The only way to really think about valuation is that it is a negotiation about the ownership stake, just in the way that I've presented you in the earlier slides. Determine how much equity the investor gets for putting a certain amount of money into the company. That's what a valuation is. So what determines a valuation? Certainly something like the quality of a deal, a better deal you would expect is going to get a better valuation. But there are other things going on. There's something like the level of competition for the deal. If you're a clever entrepreneur and you know how to create a little bit of excitement and get several people bidding on your company, you're going to get a much higher valuation, even if the underlying quality of your business is the same. Whereas if you just sort of, go to one investor and says, please give me the deal, well, they have a lot of power over you, they're not going to give you a high valuation. And so the negotiating skills of entrepreneurs and investors are going to matter a lot in this. Why do we use a valuation model? I think it's not really, we don't really know the true value of the net present value of future cash flows, which is sort of what we would ideally like to do in a finance concept. But the reason we're using a valuation model is to have some basis, some logic for justifying bargaining position. But we should, if you're thinking of valuation model, there's sort of a connection between the stock price and valuation model that people use because there's an active market where people buy and sell shares. We don't have anything like this in this world. We're negotiating deals between one entrepreneur and a small set of investors. And so these valuation models really are just used as part of that sort of human negotiation process. We will rely a lot on financial projections. Here's a couple of realities. Everything depends on financial projections in these models. Nobody ever believes those. That's just a reality. Still, everybody wants to see them, mostly to know whether you can think coherently about your business. And we will need those financial projections to anchor our financial projections. And then we recognize that, well, we're basing everything on a projection of the future that is extremely uncertain. And it's much more uncertain than in an established business with established customers where, yeah, you don't know exactly what your revenues will be next year, but you have some reasonable bounds. We don't have this. And I'm going to make a remind me comment. I have a bunch of spreadsheets as well that I can make available. So some of the things that I explain here, there are spreadsheets of a charming company called Sky in the Pie. So that's Sky in the Pie. Pie in the Sky. So, I'm going to skip model one. I'm going to show you a whole bunch of models now. And when I have time in class, I spend some proper emphasis on giving each of these models their own time. I won't have the luxury to do that here. So I'm just going to focus on 2 or 3 models. So model 1 is great fun, but we don't have time. Model 2 basically says if I want to value a company, I'm just going to try to find a similar company and find out what valuation they have. So I'm looking at an early stage mobile app. Let me find out what did other early stage mobile app companies get in the Series A. Highly unsatisfying, because there's nothing about fundamentals, just saying what are other people doing. Yet everybody does a little bit of that. And often what it does give you is it gives you some bounds. If you thought that you have you're doing a Series A, you've got a mobile app and you think you're going to get 20 million, you look at the data and you find that everybody else is getting between 1 and 5 million, well, clearly you're off in your valuation. So this is useful to sort of give you some upper and lower bounds maybe on what you want to expect from a valuation. Model number 3 is the NPV method. This is the bread and butter of corporate finance. I think everybody in the business school is or should be familiar with it. And if you're not, this is not a problem because you can read about 279 web pages and they will all explain exactly the same thing to you. So I will not do that. I will mention a couple of things about it. And this is great. What we're doing is we're determining the company's cash flow. We're finding some terminal value, a reasonable discount rate, and then there's a whole art of adjusting for risk. What's great about it, it's a standard finance method, it's very powerful. What's the weakness? It's a bit messy in a startup situation because there's so much uncertainty around it. It doesn't also take the investor perspective, so it's sort of hard to see pre- and post-money valuations and how pre- and post-money evolves over time, because that's not what the model was meant for. And so we're going to give you an alternative model that has strengths and weaknesses. This is the other model, model 4 at this point, is called the venture capital method. The venture capital method basically takes an investor perspective and it looks at the cash flows that are received by the investors. Now it turns out that investor cash flows are really simple. They invest some money now, they sit there and they pray. And nothing happens. Maybe for 2 years. And then the company comes back and says, oh, we need more money. So you put in a little bit more money and you pray harder. And then maybe 4 or 5 years later, one day it says, oh, we're selling the company, here is a bunch of cash or stocks. So the cash flows of an investor are extremely simple. And we're going to leverage that. We're going to base this method on the cash flows of the investor. Strengths, extremely simple, extremely transparent. The big weakness, though, is our results are going to vary hugely depending on relative small changes in the assumptions we make. Now that's actually a reflection of the underlying uncertainty, but that's certainly something. If we're going to use very few numbers and we get one of these numbers wrong, we're going to be way off. Here's the way it roughly works. I have a spreadsheet that will make your life easy, and the spreadsheet allows you to do a single round, 2 rounds, 3 rounds, and 4 rounds. I stopped at 4 rounds, but that's more than what you need. I'm going to show you the methodology with a single round of investment, but it is very straightforward to expand this model to multiple rounds of investment. What you need is 4 numbers. 4 numbers. Investment amount, exit value, time to exit, and discount rate. Later on, I'm going to show you a way of reducing that down to 3 lines. Right now, we're going to work with 4 numbers. So investment, exit value, time to exit, discount. These are the 4 numbers we need. Okay, exit value, we're going to use, this is important, this you're going to be doing probably in your competitions. We're going to use some kind of comparables. Now earlier on, I told you, I called something current comparables. And I said, let's find out what a Series A mobile app gets in the venture capital market. Let me get some data. And the database you would want to use for that is called Thomson 1. You might be familiar with it. If not, that's a database well worth learning. And there you see venture capital. And I'm going to call this current comparables. I'm going to contrast that against future comparables. Now this is something that if you've done investment banking or something like that, you will have seen this in a variety of forms. But instead of comparing yourself to startups, you are going to compare yourself to more established companies for which we're going to have better data. And you're going to say, if we are successful, we're going to look like this type of company. We're going to be like a Zynga or something. And so the idea here is that we're going to look at IPOs or acquisitions. So these are not, which have much better data than the venture capital data. And we're going to say, we're going to do some comparison and look at what does a successful company in my space get. And we're not trying to estimate the current valuation, we're trying to estimate the exit value, maybe 5 years from now, of what we think we can get if we're successful. How do we do this? We're going to do some kind of a comparison on the basis of a price-earnings ratio. So we're going to take our financial projections, we're going to look at our earnings, and then we're going to take a price-earnings estimate for that industry and multiply our earnings with the industry price earnings. In some cases, we don't like the price earnings, especially if we don't have earnings, and then we use the price sales. And there are strengths and weaknesses to those 2 methods. We don't need to go into the details. But what's really hard and what's a real problem in this, we have to put some time estimate. How long is it going to take us to go to exit? And frankly, we always get that number wrong. Whatever you estimate, it takes twice as long as you think. So that's useful. Here's what this looks like. I've done this all for a bunch of fictional companies. So my target company, my own company is Sky Pie, and I'm comparing myself against a few established competitors like Flute Crowd or Choco Chop Suey or whatever, and I have some data on these. I'm going to use that data to calculate some key ratios. So you can use something like the mid-range, the average, or the median, and suppose what I'm finding is that the market to revenue, that's the same as price to sales, is in a range of 1.1 to 2.2, somewhere around there. So I might say I'm going to take my own sales, so I'm going to go to the financial projections, I'm going to take my own sales of 120 million in sales, and I'm going to multiply them with a market ratio that I figured out from my market research of about, say, 2.2. And that gives me an estimate of a company value of 262. Now I've done it 3 times. I've done it with price sales, or market to revenues. I've done it with an EBITDA and with a price earnings ratio. Which one's the right one? You guys can debate that. But in this case, I'm just getting a range of valuations. This is the exit value. This is not the valuation that I'm getting for my company. This is what I think I might be worth in 5 years from now if I'm successful. Questions about that? This is an important step because people do this in a competition all the time.
So all the data that is from today, but so why is that? Why are your projections?
So that's a fundamental problem, which is the best data I'm going to have is a bunch of recent acquisitions or recent IPOs or publicly listed companies that have a share price and some earnings data. And so I'm going to have to use that and pretend that the world in 5 years will look like the world in 1. If you have some clear ideas of how it's different, then you make an adjustment. The truth is we never do. We just don't know how it's going to be in 5 That's conceptually definitely a problem. It's particularly a problem if you're thinking that, you know, the bunch of mobile apps that have gone public or gotten acquired were the good ones. And now all that's left in the market is not nearly as good, while you're going to use too high evaluation. Anyway, so the other thing, you know, everybody wants to put in their table and compare themselves against Google IPO or something like that. And nobody believes that's true. So the choice of comparables has to be credible. And say, here is a set of companies that are reasonably similar to what I'm doing, and you don't use a Google with a 200 price-sales ratio or something like that, just because that's just not representative.
What metrics will you look at if your company's pretty well unique?
You basically, in a few examples, like in the biotech industry, you can value things on the basis of patents or where you are in the FDA process or something like that. But most of the times, exits don't occur in the pre-revenue phase. And so remember, we're looking at the future.